Picture this. You've just bought an older rental, you spend 20 grand fixing it up before the first tenant moves in, and you're already mentally banking that deduction on this year's return. Here's the thing most people don't realize: it might not be deductible this year at all. The ATO can class that as initial repairs and stretch it into as little as $500 a year, over 40 years, even if you had no idea the damage existed when you bought the place. And if that feels unfair, you're not wrong. But it's not a trap you're stuck in. Over the next few minutes, I'll show you exactly how the repairs versus improvements line works, and 3 moves you can use to keep that money in your pocket sooner. Here's the number that changes everything: 2.5% per year for 40 years. That's the standard capital works deduction rate the ATO applies to most initial repairs and improvements on a residential rental. So if you spend $100,000, you're not deducting $100,000 this year, you're deducting $2,500 a year, slowly for 4 decades. Getting the classification right is the difference between a deduction you feel now and one your grandkids might see. And the good news is, you have far more control over which side of that line your spending lands on than you think. First, let's understand what initial repairs actually means, because if you've never heard the term before, that's not a failure on your part. Most landlords are never told it exists. The ATO defines initial repairs as costs to remedy defects, damage, or deterioration that were already there when you acquired the property, spent to make it suitable to rent out. These are capital in nature, not immediately deductible, even if you were completely unaware of the issues at purchase. ATO. So that $20,000 fix becomes capital works at 2.5%, just $500 a year for 40 years. If you're on a 37% marginal rate, that's $185 in tax saved a year, versus $7,400 upfront. The timing gap in the first 5 years alone is over $6,000 ATO. But here's the part most people miss, and it's where you start taking back control. Second, learn the line between a repair and an improvement, because this is where the real money lives. A true repair fixes wear and tear or damage that happens while you're renting the property out, and it's immediately deductible in full in the year you spend it. ATO. An improvement is work that enhances, extends the life of, or changes the character of the property, or replaces an item rather than just restoring it. Think of it this way: you touch up walls a tenant damaged. That's a repair. You repaint the whole house as part of a modernizing renovation. That's an improvement. You fix a broken cupboard hinge. Repair. You rip out the kitchen for higher spec cabinets. Improvement. Depreciated over 40 years. ATO. Once you can see that line clearly, you'll never look at a tradie quote the same way again. Let me show you what getting this wrong actually costs you. Say you spend $40,000 in year 1. 25 of it genuine repairs to tenant damage, 15 of it actual improvements. If a cautious accountant treats the whole lot as capital works, you get $1,000 a year deducted, about $370 in tax saved. But split correctly, the $25,000 of repairs is deductible right now, giving you a year 1 tax saving of over $9,000 at 37%. That's more than $9,000 in extra tax you'd pay in a single year, purely from how the spending was labeled. Now I want to be upfront with you here. This only works where the repairs are genuinely repairs. You can't reclassify an improvement just to bring the deduction forward, and that's exactly the line we're going to make sure you stay on the right side of. Now let's get into the moves you can actually do. Move 1, audit your last 4 years of rental expenses, because 4 years is the standard amendment window for most individuals. Log into MyGov, head to ATO online, and download your last 4 years of tax return details and rental schedules. Then go through each expense and check it against the ATO rental repairs and maintenance toolkit, sorting them into immediate repairs, initial repairs, and improvements. If you find genuine repairs that were wrongly treated as capital, work with your tax agent to lodge an amendment and claim that larger, earlier deduction, ATO. For some people, this single afternoon of work is worth thousands. Move 2, separate and document the work at the quote stage before a single dollar is spent. Before you approve any job, ask the tradie or builder to itemize each task on separate lines. Repairing existing deck boards is a completely different thing to extending the deck by 2 meters. Mark each line as repair, initial repair, or improvement using the ATO definitions, and keep photos showing the condition before and after. Then file the quotes, invoices, and photos in one dedicated property tax folder. When your invoices clearly separate the three categories, your accountant can claim immediate deductions and capital works correctly, and your tax return mirrors that split with no guesswork. And here's where it gets genuinely interesting, because the next move turns this into long-term money. Move 3. Build a capital works and depreciation schedule. List all the major works since you bought the place that count as initial repairs or improvements, with the date, the cost, and whether they're structural capital works or plant and equipment. Then calculate the annual 2.5% deduction for each one. $18,000 of initial repairs gives you $450 a year. A $12,000 kitchen upgrade gives $300 a year. ATO. Check your last return to confirm these are actually being claimed, because plenty of people build the schedule and then forget to claim it. Hand it to your tax agent so you lock in every dollar going forward, year after year. And here's a bonus move that's all about timing. A lot of landlords do a big cleanup right after purchase, paint, patch walls, fix rotten decks, for advertising for rent. Any of that work that addresses pre-existing defects is initial repairs, not immediately deductible, ATO. But where it's sensible and legitimate, you can get the property tenanted first, and then treat genuine wear and tear that happens during the tenancy as the deductible repairs they really are. Plan the sequence with your accountant. The order you do things in can genuinely change whether the ATO sees a repair or a 40-year drip feed, and that's a decision entirely in your hands. There are two common mistakes I want you to sidestep. The first is assuming anything you spend fixing a rental is an instant deduction. It's not, especially pre-purchase damage. The second is the quiet one most people never spot. An overcautious accountant who treats everything as capital just to play it safe. In one example, $5,000 of genuine post-tenancy repairs got dumped into capital works, giving only $46 a year in tax saving. Instead of $1,850 this year, that's over $1,800 missed in year one alone. And one rule of thumb to hold on to: replacing a whole item, rather than restoring it, is almost always an improvement, not a repair. Let me put it all together with a real example. Sarah, a teacher on $95,000, buys an older Brisbane house and spends $35,000 in her first year. $18,000 on pre-existing decking, plaster, and gutters is initial repairs. Only $450 a year deductible. $5,000 of genuine post-tenancy repairs gets wrongly capitalized. And $12,000 on a better kitchen is locked into slow depreciation she never even modeled. The combined first decade cash flow cost is around $11,200 in extra or delayed tax. That's real money in her tightest early years, money that could have buffered her against rate rises. If you're starting out as a landlord right now, this is exactly the period where getting it right matters most. Let's recap fast so you've got the full picture. 1. Know the initial repairs trap, because pre-purchase damage is capital, not an instant deduction. 2. Learn the repairs versus improvements line. Restore equals repair. Enhance or replace equals improvement. 3. Audit your last 4 years and amend if genuine repairs were overcapitalized. 4. Split every job at the quote stage into repair, initial repair, or improvement. 5. Build a 40-year capital works schedule so you never miss a long-term claim. And 6. Stage your pre-rental work carefully so timing works in your favor, not against you. If you've made it this far, you now understand something most landlords never figure out: that the way you classify and time your rental spending can put thousands of dollars back in your pocket sooner. Your one action today is simple. Pull up your last rental schedule and just check whether any genuine repairs got quietly dumped into capital works. It takes 10 minutes. If you want to go deeper, next up, I'm walking through how a depreciation schedule from a quantity surveyor can unlock thousands more you're probably leaving on the table right now. Get the classification right before you spend, not after. I'm Sophie. I'll see you in the next one.